Okay. It's done to scan the barcode in your monitor. Okay. Finish to all of you. Okay. Now I share about our presentation exactly in the future contract because this learning is the last but not least in capital market financial analysis. So hang on. Okay. Share. Okay. Is it clear? Okay, now our subject for today is future contract in capital market. So, what is the definition of future contract? Okay, this presentation will provide a comprehensive overview of future contract exactly, and how about the mechanism of the future contract in capital market analysis, and then how about the benefit of future contract for investor and other stakeholder or shareholder, and how about rates appear in the future contract, and about the diverse application across various asset classes. So the future contract are very powerful financial instrument that play a crucial role in modern capital market. Why the future contract powerful? Because they let market participants look in prices today to hedge against adverse price move, while their centralized, standardized nature and high liquidity facilitate transparent price discovery and efficient trading. So, by enabling and leverage speculation alongside hedging, they attract diverse global participants from farmers and manufacturers to investor and government who collectively share risks, allocate capital more effectively, and drive the smooth functioning of modern financial and commodity market. And the value at an outstanding $30 trillion in total trading in value in 2023. They enable participants to manage risk and discover prices and speculate on future asset movement. Uh, this is the future contract, very powerful and financial instrument. Okay. And the next slide about the defining future contract. So defining future contract consists of three defining of the future contract. The first one is binding agreement, and the second one is standardized term, and the last but not least, or third one is exchange traded. In binding agreement, a standardized legal agreement to buy or sell a specific asset at a determined price on a future debt, and standardized term, that is the future contract, are highly standardized, specifying the quantity, quality, and delivery term of the underlying asset, ensuring clarity and ease of trading. And last but not least is exchange traded, because the trade on regular exchange, ensuring transparency, liquidity, and centralized market price for all participants. So the three of them, defining future contract, are distinct from sports transaction, which involve immediately delivery and payment for asset to at current market prices. In contrast, or vice versa, a feature of forward-looking agreement that obligate the seller, to transaction or transact a specific asset, predetermined price, future date. Uh, this capability or this ability to look in price should at time provides a powerful tool for managing risks, especially in volatile market. And moreover, the contract are highly standardized in terms of contract size, expiration date or expired date, and we say about the uh, quality specification, which facilitates ease of trading, improve or enhance market liquidity, and ensure transparency and this standardization is a key reason behind their widespread adoption as it allow a broad range of participants from corporation and also producer to institutional investor and speculators to engage confidently and efficiently in global market. Because the future contracts are distinct from spot transaction, which involve immediate delivery. They are forward-looking agreement, allowing market participants to look in price for future transaction. And this standardization is critical for their widespread adoption and efficient trading. So this is the role in capital market. There are three steps in risk management and price discovery and speculate. In risk management, hedging against adverse price fluctuation, protecting portfolio from unforeseen market movement, and approximately 85% of future traders utilize this contract for hedging purposes. And the price discovery, future prices reflect the collectively expectation of market participants, revealing insight into future supply and demand dynamic. And future contracts are indispensable tools in capital market, serving a versatile instrument that support a variety of strategic financial objectives. Beyond their fundamental role in hedging against price volatility, such as protecting portfolio from unexpected market shifts, they also empower investor and institution to speculate on future price movement, optimize asset allocation, and manage exposure across different sectors and asset classes or classification of asset. Their standardized structure and centralized trading platform ensure high level of liquidity, transparency, and regulatory oversight, making them accessible to a broad spectrum of market participants, from corporate treasurers and commodity producers to hedge fund and individual traders. As such, future play a vital role in enhancing market efficiency, supporting price discovery, and contributing to overall financial system stability. And then this is the mechanics of trading. So there are three steps for the mechanism of trading. The first one is margin requirement. Traders must deposit on initial margin, typically 5 until 50% of the contract total value, acting as a performance bond. For example, is $100,000 contract might require a $5,000 margin, marking to market. Daily adjustment to account to profit and losses, ensuring that account reflect current market value and maintaining financial integrity, and clearinghouse rule, a central entity that guarantees the performance of every contract, significantly reducing counterparty risk for traders. So the understanding this core mechanism is crucial for anyone engaging with future contract. So three of them: margin requirement, marking to market, and clearing house rule allow for a leverage position while daily marking to market ensure financial discipline, and the clearing house provide a robust safety net for all transaction. So this is the benefit of future contract. Okay. Uh, in effective hedging, offer robust protection against the first price movement in underlying asset, guarding existing investment. Uh, and high liquidity facilitate easy entry and exit from position, minimizing transaction cost and ensuring efficient trade execution. And a significant leverage enable control over large asset position, which are relatively small amount of initial capital, maximizing potential return. And market transparency, price and trading information are publicly available, fostering fair and efficient price discovery for all participants. So the future contract over a range of essential benefit in capital market, including serving as a hedging tools protect investor and businesses from adverse price fluctuation with leverage features. This contract enable the management a large position with relatively a small capital, enhancing capital efficiency. Additionally, future market provide high liquidity and transparent price discovery mechanism that reflect collective expectation of future prices. The standardized nature of the contract, regulated by official exchange, ensure transparency and reduce contemporary risk. Feature also support portfolio diversification and allow for global participation, making them a crucial and versatile financial instrument in the modern financial system. And then not only benefit but also future contract have a risk. Yeah, not only benefit but also risk. So what is the risk of future contract for investor or the shareholder? There are the leverage amplification and market volatility and margin calls. In leverage this despite their numerous benefit, a future contract also carries significant risks and largely stemming from their inherent leverage and the high volatility of the underlying market. Leverage, while amplifying potential profit, equally magnifies potential losses, meaning that even small adverse price movement can result in substantial financial damage. Additionally, sudden market shift driven by economic event, geopolitical tension, and unexpected news can lead to rapid price swing that are difficult to predict or control. Therefore, it's very essential for trader investor to not only understand the mechanic of future contract but also to have a deep awareness of the associated risks. Implementing about the discipline and well-structured risk management strategies, such as setting stop loss order, maintaining adequate margin levels, and diversifying position is really crucial to safeguarding capital and ensuring long-term sustainability in future trading. That is the uh, explanation about the risk of future contracts. So not only in benefit, but also future contract have a risk. Okay. The uh, the example of future contract, for example, is the commodity, cryptocurrency, financial, and currency. The diversity of asset available for future trading like the facility for traditional commodity of cutting cryptocurrency, future market over a broad spectrum of opportunity for various strategic needs. So this is I said to you about the simple example about the future contract. So here's the example. So the example question is an investor buy two crude oil future contract at a price of $75 per barrel. Each contract represents 1,000 barrel. A few days later, the future price rises to 80 US dollar per barrel. And the question is, how much profit does the investor make from this position? So the answer is the step one, we calculate the price difference. So the 80 minus $75, so the 5 US dollar per barrel. And the next step is the step two. Calculate the total volume held by the investor to contract. Multiply 1,000 barrel is 2,000 barrel. And step three, last step is calculate total profit. So the 2,000 barrels multiply 5 US dollar. So the total is 10,000 US dollar. The conclusion is the investor earn a profit of 10,000 US dollar from the rise in crude oil future prices. So if I explain with detail about the simple question in your monitor, so an investor will purchase two crude oil future contract at 75 US dollar per barrel, which is contract representing 100,000 barrel, stand to benefit significantly from favorable price movement when the future price rise to 80 US dollar per barrel. The investor gains 5 US dollar per barrel, given the total volume 2,000 barrel. So two contract multiply 1,000 barrel, the over profit amount to 10,000 US dollar. This example is how future contract can generate substantial return through price speculation, though it also highlight the importance of understanding position size and market movement in managing both risk and reward. So this is the participant in future market. Who is the participant in future market? First one is hedgers. The businesses like agriculture, producer, consumer, and processor use future to lock in price and manage commodity risk. And the speculator, individual hedge fund and commodity trading advisor or CTA aim to profit from short-term price movement, adding vital liquidity. And the last but not least is arbitrage. The professional who exploit minor price difference between markets or assets to generate risk-free profit, ensuring market efficiency. So three of them is the participant in future market. And the future market is a vibrant ecosystem comprising diverse participants, each with distinct motivation, and the recent 20% years over years increase in retail participant underscore the growing accessible and appeal of this market to broader audience, fostering greater liquidity and innovation. So how about the regulation? Uh, all the shareholder is obey with the rules. And how about the regulation and oversight? The first one is CFTC authority. So in the United States, the Commodity Future Trading Commission or CFTC oversee future market, ensuring integrity and preventing manipulation. The exchange rules. Each exchange enforce its own set of detailed rules and compliant procedure to maintain fair and underlying trading. So in margin and limit, strict margin requirement and position limit are imposed to mitigate systemic risk and prevent excessive speculation. So robust regulatory framework are essential for maintaining confidence and stability in the future market. These measures are designed to protect investor, ensure fair pricing, and uphold the overall integrity of the financial system, fostering a secure environment of trading. So this is we now the last slide is also the conclusion feature for capital market. There are three conclusions in future for capital market. First one is essential tools because the future contract are in this indispensable for risk management, providing effective hedging strategy against market volatility. And the second one is the complex instrument. There are sophisticated financial product. Jadi not only in sophisticated technology, but this is the sophisticated financial product that require expertise and caution due to inherent leverage and market risk. And last but not least is growth and innovation in future contract. The global future market continues to expand and innovate, adapting to a new asset classes and evolving market dynamic. So this is the conclusion of the future and capital market, but I will explain with detail about the conclusion after we learning in the capital market directory subject in the future contract. So the future contract remain a cornerstone of capital market, offering essential mechanism not only for managing financial risks, but also for uncovering opportunity across a wide range of asset classes. This contract enable participants from farmers and manufacturers to institutional investor or hedge fund to hedge against price volatility, speculate on future market direction, and optimize asset allocation strategies. While the structure and dynamic of future trading can be complex, really complex, okay, requiring in-depth knowledge and disciplined execution, this very sophistication is what allows for tailored financial strategy in an increasingly interconnected and fast-paced global economy. The continued expansion and innovation within the future market, including the emergence of new asset classes such as cryptocurrency and carbon credit, reflect their growing or improved relevance. As such, future contracts play a critical role in ensuring market efficiency, enhancing price transparency, and supporting the functioning of diverse economic activity and long-term strategic investment around the world. I think that's all for today in our lesson about the future contract. See you in the final exam. Okay, for the schedule, maybe I will tell with the Naulia as the chief in your classes. Thank you and Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam
Waalaikumsalam
warahmatullahi
warahmatullahi
wabarakatuh. Thank you.
wabarakatuh. Thank you, Chef.
Okay, see you in final exam, all of you. Okay.